What's going on, guys? In this video I wanted to discuss AT&T and break down the potential upside to the stock. So I hope you enjoyed the video. If you do, make sure you drop a like down below, and if you want to see more videos like this, make sure you hit the subscribe button. So if you're a shareholder of AT&T, you've kind of suffered some of the pain. I personally am a shareholder of AT&T. I've been holding it for over a year, and if you know that, if you've been holding it for any extended amount of time, you've kind of seen the stock drop. And today alone, we're down 1.17%. In the last 5 days, we're down about 0.5%. Month down 4.5%. 6 months down 17%. And then year to date, again, almost down 17%. So what we've seen here is a drop off basically here in May. This is when they originally announced them spinning off the Time Warner. And basically, as this article kind of says by the Motley Fool, they were spinning off Time Warner, merging it with Discovery. And basically what was going to happen in the merger is that AT&T would receive $43 billion in cash and debt, and its shareholders would also receive 71% of the new company, while Discover shareholders would own basically 30% of the company. So this article just kind of goes a little bit and explains that. But it's not only AT&T. So you are seeing that obviously in AT&T, and that's kind of when you started seeing this original drop here, like I said, in May, but it's also across the industry. So what you're seeing here is Verizon, right? And Verizon, since basically May, the same time period, you're seeing has fallen quite a bit. Obviously, it's down a little bit less than AT&T, but it's down 12%, a little over 12%. And then T-Mobile is also down. So T-Mobile, it took them a little bit longer to get to that point. So this is that kind of May 14th. You see that same little drop here, but they had a run up afterwards and then basically ran down since then. A lot of this overarching basically drop in telecommunications has to do with the fact that a lot of these players had to put a lot of money into basically expanding their 5G networks over 2020, over the 2020 year time frame and into 2021, because they're all basically competing to try and have the most built out 5G network and basically use that as their selling point. And you kind of have more competition now in the space, because T-Mobile has when they merged with Sprint, they took on a larger market share, and now there's really only 3 main players in telecommunications. So they're kind of all feeling this pain, and it's really a matter of who's going to bounce back and who's going to kind of keep things going. And that's why what I'm going to get into here next is kind of the upside that I see in AT&T. Obviously, it's down the most, and for me, that alludes to the fact that it has more potential to go back up. So if you've seen my Alibaba video, you know I like looking at PE ratios and basically comparing them to price and being able to come up with an estimate of where the stock could basically potentially bounce back to. So what we're seeing right now is the stock price is around 24.47, and then the forward PE ratio, that's obviously more accurate than these numbers that Yahoo is giving us. But right now the forward PE ratio is 7.62, and if you kind of look at these other quarters of the year, you kind of see a trend here where it seems to be sitting around a 9 PE ratio. So here it's a little bit higher, here it's at a 9, here it's at a 9, here it's just below a 9, and then here obviously we're starting to get some of that dip. So you're seeing that it's below a 9 as well. So what I like to do there is basically come over here, and I have that information basically entered in here. So what we have is basically the potential PE ratio, right? We're seeing that it's averaging around 9. The current forward PE ratio is that 7.62 number, and then the current price is 24.47. So if we basically just look at this, right, and remove this, we can see that just by doing a little bit of math, which is basically taking the price, multiplying it by the potential PE ratio, and then dividing it by our current forward PE ratio, we come up with a price target, or a potential price, if the stock were to go back up to a PE ratio of 9, of 28.90, which obviously is fairly realistic. If we bounce back over here to the chart, you'll see it was around 28.90 kind of back, it looks like in here, so back even in July, so just a few months ago. And then, right, what does that difference make up? So right now, if you're buying the stock, you basically have a very reasonable upside of 18.11% at its current price. So I don't think this is out of the realm of question. I think if anyone kind of looks at the chart, right, that's a reasonable number. You had a lot of support kind of around this number, around the 28, 29 number that you're kind of seeing in here. And even before the news broke, you saw a lot of support around there. So I don't think that's unreasonable at all. And I think it's honestly very, very likely that the stock goes back up there. And you can see, right, at the current price, you have a potential upside of 20% on a very solid stock like AT&T. So another huge thing with AT&T that people love to look at and kind of the core business of AT&T is the dividend. So right now you're actually at a dividend of, I believe it's around 8%, which is insanely high for a stock, actually 8.4% that you're seeing here. So it's giving you a yearly dividend on every share that you own of $2.08. So what we can do is basically try and look at the safety of that dividend. So that's always in question, especially for more conservative investors. They want to look and make sure that they're going to continue to receive that income. I know there's been talks and concerns about basically them lowering the dividend, but what you're seeing here, right, is their earnings per share. So what was forecasted was around 78 cents, around 70 to 78 cents for the last 4 quarters, and AT&T has beat basically on every quarter of the last 4 quarters. And you can see most recently they've actually been beating by double digits, so percentage wise. So they beat by 11.69% here, they beat by 14%, and they beat by 11.54% here. So if you break out the $2.08 per year into quarters, basically you end up with 52 cents a quarter. So what you can see right now is basically they're beating that by over 30 cents, so 35 cents here, and then obviously you can do the math on the rest of these, but basically they have 35 cents on top of their original, basically on top of their dividend that they have in profit that they can basically send to the bottom line and use to pay off debt and whatever else they basically need to do. AT&T is a dividend aristocrat, which means they've been basically growing their dividend for 25 plus years. So it's likely that they could continue to basically grow their dividend. They have the potential there, but also you want a company that's stable, and AT&T has been known to have basically a lot of debt. So they also have the money there to basically keep paying down that debt and kind of keep that managed and basically in control of their debt. So here I'm only seeing positives. The real question comes about when they break off Time Warner. How much of their earnings basically does that make up? Which what I'm going to get into here kind of next is I don't believe that is a significant amount of their earnings. So I jump back into this slide, and this kind of breaks down one of the key factors that I think is going to lead to basically AT&T and a lot of the value that you're seeing in AT&T right now, and that's the spin-off of Time Warner Media. And basically Time Warner Media is going to jump in and basically merge with Discovery, and those two will be their own business, and then you will still have AT&T kind of as its own standalone business. And what you'll end up with is, like I mentioned in the start of the video, is if you're an owner of AT&T currently, you will gain a 71% share in this new company. And if you're an owner of Discovery currently, you'll actually gain a 29% ownership of this new company. So that has a huge benefit, and I want to jump back to what I was talking about with earnings, right? So Time Warner, the biggest thing with this is you have basically a bunch of TV channels: CNN, TNT, TBS, Food Network, HGTV, but the biggest thing is HBO, right? HBO is going to be a huge growth factor for that business. So a lot of what you've had in the past is basically two sets of investors. You have growth investors and basically more stable value type investors. And they both look at AT&T and they both see companies that basically are struggling with who they want to be. You have the growth aspect, right, which was Time Warner and HBO. And obviously the kind of more stable value investors would look at that and see all this debt that AT&T added and basically think that the company is unstable. And then you have the other side, you have the growth investors that are looking at AT&T and basically saying, we like HBO, we like the growth prospects there, but we don't want AT&T because, right, it's a boring old basically dividend company. So what you're getting here, if you invest in AT&T basically now before they issue out this equity, is you're getting the ownership of both companies. You're getting the ownership of basically this Time Warner, this spinoff that's going to happen, and AT&T. So you have growth and you have a solid basically dividend player. So what I think you're going to see, and kind of what I'm betting on or think is a solid assumption, is when both these companies spin off, you will actually get new investors coming back to these companies, specifically back to AT&T. Basically, since they unloaded that debt, I think a lot of investors were kind of turned off by that merger or them purchasing Time Warner. But now those investors all can basically come back, right? Because AT&T is basically still the same company. It's still going to be that boring telecommunications company, but it's solid, and it's going to basically offload a lot of this debt onto this new company that is Time Warner Media. And a lot of people who basically liked HBO but didn't want the AT&T business are now going to see this new company and say, why wouldn't I buy that, right? It has all the growth, and you're going to see it in the metrics, right? AT&T basically in the past, in other earnings, you haven't necessarily seen the growth and the growth potential and the excitement around HBO because it's kind of hidden behind all this telecommunications things that are going on with AT&T itself, the phone business there. So I think basically you get the best of both worlds when this spinoff ends up happening, and I don't think HBO and a lot of these other kind of networks and whatnot has accounted for a lot of AT&T's basically earnings. I think AT&T's always kind of had a good backbone of earnings, and I don't think when it spins off you're going to see a lot of the basically drop in that earnings. So that's kind of what I'm banking on. Like I said, this is more of a kind of a boring play, but sometimes the boring plays kind of have the most stability and have basically solid potential, right? There's less risk in it. So I talked in my last video, if you didn't see it, it was about Alibaba and how you kind of need to weigh the risk when you're making an investment. And this would be one of those cases where I really don't see a whole lot more downside risk because of basically the stability that you have from AT&T as well as the basically growth potential that you're going to gain through HBO. I hope you guys liked the video, and if you did, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that subscribe button down below, and as always, I hope you have a wonderful rest of your day.